First way, it's Monday morning, a brand new week. And even though the handover last week was not that scary, barring Friday, the markets are off to a decent start. The breadth is the positive story. The breadth is looking strong. Nifty is off to a flat start. Sensex is off to a flat start. Both within the small cap indices, for the moment, they are not going anywhere. I think it is evident in the way how the screen is opening up. Now let's address the newsmakers, Reliance and banks. Across the board banks. Let's wait. 2% lower for Reliance. This is on top of what happened on Friday. ICICI Bank flat start. Kotak down. Nothing wrong with the numbers. And then let's look at RBL and AU. AU was bad, so AU definitely will be on the receiving end. RBL okay. Yes Bank not that great. So AU is down, and Yes Bank I would imagine will be reacting to numbers as well. There you go.
Yeah. A lot of other stock reactions as well coming into earnings. Nikunj highlighted Reliance as well as the private banking names, the major ones. But there's RBL Bank. The NIMs have come in at 4.8%. The NPA ratios are at a 16-quarter low. But for RBL also, you're not really seeing any much of a reaction come by. There's HCC. That should be the dhamaka this morning, given that Lavasa resolution plan got okayed 1.25% higher for HCC as we speak. Credit Access, CLSA has raised the target price to 1600 from the earlier 1350, and that stock is a big mover this morning, 6.5% and now 7% and counting even further as we speak. AU Small Finance Bank, of course, was the disappointment. Axis Cap has downgraded it to a reduced margin outlook weak. So look out for some of these names. A lot of other numbers as well. Look out for IGL. The earnings have clearly come in below the consensus estimates. So that is another stock which is in focus. Paytm, wherein the net loss has widened sequentially. But yeah, the street is actually liking the numbers, and the brokerages are continuing to maintain a buy on this one. Paytm starts off just about marginally in the green as we speak right now. Then, of course, there are a couple of pharma newsmakers as well. There's Oro Pharma. US FDA has issued a Form 483 with 3 observations for their Telangana unit. There's Lupin as well, which has got a US FDA nod for 2 of their tablets. So look out for that stock as well. Cyan DLM has come out with an excellent set of numbers. Margins have expanded almost about 240 basis points. DLF wherein the net debt has declined to about 57 odd crore rupees. But yeah, I guess it boils back to what ICICI Bank, what Reliance and what Kotak are doing, considering these are the market movers this morning. So very, very tempered for ICICI Bank, down sharply for Reliance and for Kotak Bank. Not quite anticipated, right, this reaction?
No,
not
Kotak
on Kotak
was not. Kotak was not. ICICI Bank you knew was best, but Kotak is expensive. That is always the challenge. I mean, if you frankly ask me, it's ICICI Bank, HDFC Bank, Innocent Bank and Kotak, but Kotak is not that bad that warrants a 2% sell-off. So Kunal, what do you make of the opening?
Yeah, again, I think it's going to be a mixed session for the indices because there are a lot of sector churns which are happening. So I'm expecting 90,700, 800 as a broad range for the index, broadly on the spot levels today. In terms of opening stock, IDFC First Bank is something which looks attractive. The stock is on the verge of confirming a breakout of a 2 to 3 week of consolidation. So that's a stock which I look to trade in the open.
Okay, that's an IDFC First. And by the way, the Nifty Bank is absolutely flattish in today's trading session, despite what a Kotak Bank is up to. ICICI Bank is managing to hold out in the green. Let's get in your thoughts then, Naresh, on the Nifty Bank and how Kotak's performing this morning, and what are you punching in as your first trade?
So expecting consolidation to continue on the Nifty as well as the Nifty Bank. 19,600 is a support to watch out for, which is where you want to buy on dips. In terms of stocks, oil and gas looks interesting. That is where ONGC has given a breakout. So that looks a promising one. A new 52-week higher could surprise on the upside.
Well, what's going higher is actually Zomato. And where is Paytm? Let's not lose sight of what's happening to the fintech and the consumer tech stocks. 81 for Zomato. And Paytm, please. Then we'll go to Pratik Gupta.
It's up in the green. It's up about a percent at 849 thereabouts.
They've delivered actually. That's the whole thing. These stocks are now delivering. Pratik Gupta joins us, CEO and co-head institutional business with Kotak Securities. He joins us live. Pratik, good morning. Thank you for joining us. It's been a good year so far, Pratik. Especially if I look at the market from the month of April. What is driving the market? Is it liquidity or genuine turnaround in macros?
Hi, good morning, Nikunj. It's a bit of both, actually. One is obviously the big turning point came when expectations globally started building up that the global interest rate hiking cycle is probably nearing its peak. And obviously, June was the inflection point. And this week, as you mentioned earlier, we have the Fed, which will likely hike rates perhaps for the last time or maybe one more time at best. So that's the big driver of global flows into risk assets like emerging market assets in particular. And India has been a beneficiary of those assets. In fact, as you know, it's been the strong FPI flow which has been driving our market. But I would just like to clarify that, it's not just India which is doing exceptionally well or doing well. We always look at China versus India. But in the US, for example, our Nifty is up only 9%, but the S&P is up 18% year to date from January till now. The Nasdaq is up 34%. Japan is up some 24%. Korea is up 18%. Taiwan is up 20%. Even smaller markets like Vietnam is up 44%. Sri Lanka is up 30%. Even Pakistan is up 13%. It's a broad-based global equity rally, and India has been a beneficiary. So that's point one. And second, I think what's also helping India in particular is also our own macros have turned out to be quite decent. The current account deficit is okay. Inflation is under control. Corporate earnings growth are holding up. At Kotak, we are expecting about a 15% earnings CAGR for the Nifty in FY24 and FY25. And so far, the earnings seem to be by and large okay. There are obviously individual companies doing a little bit better or worse, but by and large, it's been quite okay. So what's happening is we are seeing a global equity rally. India is also participating. The local flows remain strong. Monsoons was a big risk factor, but that seems to be fading. It seems to be going well. So by and large, it's looking good for the time being. Obviously, valuations are getting a bit expensive. So let's see how long this lasts.
Watching the show, what should they do? I mean, that's a simple advice.
Sorry, can you repeat the question?
For those who are watching the show and if they want to understand the market from your lens of valuation as well as flow, what should be the basic approach?
Well, I think as always, equities is a long-term game. In the short term, clearly we are getting quite concerned. We are getting cautious. We think the market has entered the expensive zone. If you look at the Nifty, for example, is trading at 21 times FY24, 19 times FY25. We are at almost a 70% premium to the MSCI Emerging Markets Index, and typically the range has been 20% to 80%. So we're probably at the upper end. There's still perhaps a little bit of overshoot possible over there. Or if you look at our market compared to bond yields, earnings yields are roughly 5% versus bond yields of over 7%. So whichever metric you look at, we are in the expensive zone. So in the short term, anyone who has a short-term investment horizon, they should be a bit cautious. Although, as we've seen many times in the past, you do tend to get valuation overshoots. So now if you're investing now in the short term, you're playing for that valuation overshoot, which is always very risky. Longer term, I think the outlook is more attractive. If you have a 3-4 year investment horizon, we think the corporate earnings growth cycle should remain quite strong, especially if the private sector capex cycle picks up. So we think you'll see 15-16% earnings growth over the next 3 to 4 years. And even if you have a modest derating, even then, I think the returns can be quite attractive. So it depends on your investment horizon. Short term, we would be cautious. Longer term, we are still quite optimistic.
Let's talk about the near term then, Prateek. And what is it that you made of some of the banking earnings that we've seen? Does it seem like, the margins are peaking out? At least, some of the managements pretty much categorically said that this is the peak of it in the near term.
Yeah. Yes, we do. We also believe that margins are peaking out, and it's tough to expect the same NIMs to continue going forward. But equally, the question is, are you expecting a very sharp decline in NIMs? Then the answer is no. We think there will be a gradual moderation, not a very sharp decline. And I think for the banks, the bigger point is the loan growth cycle is still looking very strong. Loan growth, on average, which should be 15 to 20% and may even accelerate in the coming quarters. And equally, and is the credit cost part of it, which we think will remain quite low even in FY24 and perhaps going into FY25. So banks are actually our top sectoral pick at the current valuations, both from a fundamental business outlook perspective as well as from a valuation perspective. Banks still look good. They're in the sweet spot where credit growth is picking up. The NIMs are moderating, but very slowly, and credit costs are likely to remain low for the next 1 year at least. So we like the banks. Banks are actually our top sectoral pick right now.
Pratik, the other sector, of course, which has really been the talking point as up until Friday was IT. While TCS, HCL Technology and the likes were okay, but I think the shocker came in from Infosys. Did you anticipate this kind of a commentary coming in from them?
Not the commentary, although we have been expecting that things will slow down in the September-December quarter, perhaps even the March quarter. So we were anticipating a slowdown in the business. The guidance obviously was a bit of a surprise. You saw the stock reaction thereafter. But in general, we have been expecting that the main market for these companies is the US, which has been expected to slow down. Discretionary spending has been coming down. So obviously the speed, the decision-making timelines are getting elongated. Discretionary spending is coming off. To that extent, clearly the outlook would not have been as strong. And we have been a bit cautious on the sector in the past for the last several months. And even now, I would say we're not totally, out of the woods as yet. Things can get worse if the US slowdown worsens. Although increasingly it's looking like they might just be able to get away with a very mild slowdown or a mild recession, in which case we'll probably just hover around the bottoms for the time being. But to expect a quick recovery in this sector is unreal. I would just also caution that it is the mid-cap IT companies where I think one needs to be more careful of, where they're more vulnerable to a slowdown in discretionary spending. And also the ERD companies, which tend to get a bit more impacted when there's slowdown in discretionary spending. The large caps will still do relatively better, but in general, we would stay away from export-oriented sectors.
Pratik, hi. Wanted to also get in your thoughts when it comes to the entire auto space. It's going to be in the spotlight, especially this week, with a whole host of numbers expected. Do you think that given the kind of fury that we've seen on the upside, or the kind of strong run-up, that now the auto companies will have to go above and beyond when it comes to their numbers being positive?
Yes, absolutely. To sustain these valuations, we think the numbers will have to be something quite dramatic. We need to see a very strong pickup in overall industry demand. Our concern on the auto OEMs is more the increasing competitive intensity, both from the existing listed players as they are, as well as a lot of the unlisted players, both in the two-wheeler and the four-wheeler space, where the Japanese, the Koreans, etc., and in the EV space, for example, in the two-wheelers, you have some Indian folks as well. So competitive intensity is increasing very, very dramatically, and we think the market is being overly generous in giving these kind of multiples. They're simply extrapolating that this is just a repeat of the old cycle where industry demand picks up and these companies again start delivering great volumes and free cash flows thereafter. But the change this time around, in our view, is that competitive intensity is going to be very, very different. Some of the incumbents, their product pipelines are not as strong, and you therefore, as a result, you may not see the same kind of sales or margins, and therefore the free cash flows going forward. So valuations right now are going back to the old. In fact, they've gone above the past multiples. So we are cautious on the auto sector.
There is a binge in luxury cars. There is a change in SUVs. There is a strong uptick in CVs. If I look at the credit numbers which banks are reporting in terms of vehicle financing, all of them are indicating the demand is robust. So while historical valuations may not be on your side, some would argue and say that history is history and money is not made by looking at history.
No, that's true, Nikunj, but also some of these data points, they may not necessarily be pointing to the listed companies being the beneficiaries. A lot of the demand is coming from the two-wheeler EV OEMs, for example, or from the Kias and the Korean players in the four-wheeler sector. The CV cycle, yes, there we are slightly more positive compared to the two-wheelers or the passenger car segment, mainly Maruti over there. But the point is, demand is definitely picking up. We're not disputing the demand pickup, and the monsoons have been good, so we could probably see a good rural pickup as well. But I think we're questioning the longer-term outlook for these companies, given the likely increase in competitive intensity with more players, with electric vehicles coming in, a big disruption coming in over there. Their incumbent legacy portfolio business cash flows potentially at risk going forward. They'll have to cannibalize that to grow the EV segment. So in that respect, therefore, giving the same kind of valuations, we are a bit nervous. So we are staying away and recommending investors to stay away from the auto sector.
All right. Appreciate your time. Thank you so much for joining in and sharing with us your thoughts on individual sectors as well as the markets as a whole. Just checking in as to what the index is up to at around 19,728. Jayant Acharya, Joint MD and CEO at JSW Steel with us, joining in to talk about the numbers. Thank you so much for taking time out. It has been a beat in Q1 versus what the street was penciling in, but still, sequentially, there has been a dip due to the lower volumes and the higher iron ore cost. What exactly is the outlook in terms of all of these individual dynamics on where your earnings are headed?
The global economic situation, as all of us know, have challenges, but it has been resilient. I think World Bank has improved the forecast by 40 basis points, and we see some small recoveries in some parts of the world. Having said that, I think the supportive factors are a declining inflation, a lower commodity price, and energy prices. India, the strong economic momentum continues, and we see it's driven by both the business and the consumer sentiments. The services and manufacturing both are doing well. The growth continues to be supported by a very strong capex from the government in infrastructure. The manufacturing activity is good. It is further supported by a supply chain realignment, which is happening globally, and India is benefiting out of that. We see a stable currency and FDI inflows and FII inflows, which is coming into India based on a strong, India outlook. The global steel industry, by and large, has moderated production between Jan to May by 1.2%, but China production went up, and the rest of the world came down. China, unfortunately, the demand did not play out as we thought post the freeing up or opening up of the economy post-COVID. The demand, therefore, was not supportive of the production, and exports increased. However, China has declared that they would like to cap the steel production to last year's level, which means that in the H2, the production would get moderated, and that would be positive for the global steel industry at large. Indian steel consumption in this quarter grew by 10%, which is one of the good numbers, good performance in a quarter one. And we see 8 to 9% growth for the year, which would incrementally add 10 to 11 million tons. We expect India to consume about 130 million tons ballpark in the year.
Right. So fair to say that you are on track for the 25 MT sale guidance?
With your question on the guidance, on production for quarter one, I think our numbers reflect we are on 100% of the guidance. On sales, we are at about 93, 94%, and we are confident that we'll be able to achieve the guidance this year. We have added some inventory in this quarter, primarily due to the cyclonic impact in the second half of June. Many of our materials which were in transit to the port and loading were impacted, and some part of the sales in the western part of affected cyclone area got impacted. But we are quite hopeful that we'll be able to liquidate the inventories in the coming months.
That there is a benefit of lower coking coal which will come in second half. What will happen to that? How will that help your EBITDA per ton expand?
So it would be difficult to give a EBITDA per ton number, but I would like to hazard a guess saying that the coking coal prices and softer, maybe slightly softer iron ore prices, which we expect, will offset the fall in prices which have already happened. The steel prices, as I said, have bottomed out, and therefore the margins we will be able to either maintain or it will remain range bound.
Okay, your net debt as well has risen this quarter to about 66,800 crores, largely due to the higher working capital requirements. Could the debt continue from here on, or is there a plan to keep it around this range?
Yeah, so the debt in this quarter has gone up because of two main reasons. One, we have added inventory of about 300,000 tons odd, which has resulted into some working capital going up. We have also paid off some of our higher coking coal priced, which was due in this quarter, and that has again added to the working capital cost. So therefore, the working capital during the quarter has gone up. We expect that we will be able to liquidate the inventory in the coming quarters, and some of this would therefore come off, and you will probably see a slightly better number than what you're seeing today. Having said that, that would happen, the better number should happen in spite of the fact that we will merge JSW Ispat. We have got the clearance from the necessary approvals have been obtained, so we would merge it in Q2, and that would add some debt. But in spite of that, we are confident that we'll be able to get it down below what it stands in Q1 today.
Right. So since we're talking about balance sheet, we understand that there is NMDC Steel as well, which is on the block. Vedanta might look at selling steel business too. Would you be interested?
So NMDC, we had filed our expression of interest, and we were shortlisted as one of the parties for that. The data rooms are open now, and we are analyzing the data which have come in, and we would look at the data and then take a view. As far as Vedanta is concerned, I think that is a news of late which has come into the market. We are also analyzing that, and we will take a view. I think we understand it has the steel as well as the mining assets. The mining assets hold more interest for us, but we are evaluating the situation, and then we will take a call.
Right. So you are interested in not ruling out acquisitions, and separately, JSW Steel is also set to mull a bid for buying about 20% stake in Tech Coal unit, close to $2 billion. Can you clarify the details? Is that true?
So our priority, as we have mentioned earlier, will be raw material security as we are expanding our capacities in India. And therefore, we will focus on iron ore backward integration and coal backward integration to the extent possible. Metallurgical coal, when I say coal. So therefore, in India, we have acquired new mines in the iron ore auction. 6 mines have been recently acquired, and we would make efforts to operationalize 4 of them as quickly as possible. 2 coking coal mines which have come to us would also get operationalized in the next 2 years and would give us about 1 million tons of coking coal. In addition to that, we are looking to supplement our coking coal requirements by some hard coking coal assets internationally. And we are looking at assets strategically in different countries, including Australia and Canada. We have looked at the Tech asset, but however, it is a feasibility study which we are doing. Among Tech, we are doing others as well. And I think it's difficult to comment at this point of time on any valuation or interest. I think it is still early days.
Right. So are you looking at NMDC, Vedanta as well? You think the balance sheet has the wherewithal to take all of this in?
I think the way I would look at it is, as I said, our will be, as far as Vedanta would be on the mining assets. They have a iron ore mine in Karnataka and in Goa. We would be interested in certain assets in that sector. However, we'll have to look at the details. We still don't have it, so I will not be able to comment further on that. On the coking coal, as I said, we will take a call. We need to do backward integration, and we are confident that we will be able to get financing required to do some kind of a strategic investment in any of the hard coking coal assets which we look at, but it will be commensurately small compared to our total requirements. So we do not see a problem on the balance sheet to be able to take that.
Appreciate your time. Thank you for walking us through all those details, acquisition plans as well. So as of now, you're analyzing the Vedanta Steel assets, and that's the latest when it comes to the merger of JSW Ispat, and talking about how they have maintained their sales guidance. That's JSW Steel at about 780. But time to shift gears then. Let's discuss banks in greater detail. A bulk of the earnings did come out over the weekend, and Nitin Agarwal is the head of BFSI and research at Motilal Oswal here to talk about the earnings. And Nitin, I want to just start off with Kotak Bank in particular. Given the fact that it has been a fairly decent quarter for the bank, what's your outlook on the kind of reaction that the stock is seeing in today's trade? Because asset quality has been fairly strong, and the general view is that we will see momentum continue to improve.
Yeah. So Kotak Bank reported fairly good numbers. In fact, the other income has driven a beat to our numbers. And there has been a compression in margins, but that was pretty much on the expected lines. And that's something we are seeing across many other banks now. And but I think today's reaction is more to do with the fact that going into the results, the stock has been doing very well over the past couple of days and weeks. And even our rating has been neutral on the stock, because if you look at Kotak is relatively expensive in the sector still, and which is where the upside that we are looking at in the stock over the next 1 year is still limited. And so which is where I think we still prefer some of the other large banks over Kotak.
Is there a case for larger banks now to do significantly better than small and mid-tier banks? Because that seems to be the trend, at least in profit. Small banks are losing CASA, their NIMs are peaking out, even though growth may be comparable, but the bases are so large that that may not be a fair comparison.
Right, which is there, yes, because as you move forward, while a large part of the deposit repricing has happened, and that is showing in the cost of deposits, and there's a fairly high differential now between where the large banks are and where some of the small and mid-sized banks are. But incrementally, large banks are still better placed, because despite the earning compression that we are looking at, like if you look at our report, we have put out the earning growth by Q4, because we give out the quarterly trend in our reports, is going to just fall flat by Q4. And that's something similar to what we are looking at the compression for the other banks also. So not at the same magnitude in terms of growth, but that directionally every bank is going to show moderation. But large banks overall are still looking to do better on the full year ROAs and ROE. And which is why, given the growth that we are looking at and the other operating metrics and the return ratios, they still look better in the sector.
Banks is the consensus view. Everybody has a major ownership in banks. And typically we've seen consensus never plays out.
Mm-hmm. Yes, I have seen that at times, but there have been times where it has not worked also. If you look at last 3-4 years, ICICI Bank has been a consensus buy stock. And that has been one of the best performing stock in last 3 years. So I think there'll be exceptions to that rule. And the returns overall can still lag ROE at the sector level, which is what we think may happen this year, because you are now looking at FY24 from a viewpoint that earnings will keep on moderating every quarter. And margins also will keep moving down. The best of the asset quality, the credit cost that we have seen is likely behind. If you look at Q1, in general, there has been some fairness that you are now seeing coming into the credit cost part. And going forward, while it's tough, the overall credit cost may still remain pretty much in control, but we are not looking at that decline anymore in particular, what we have been looking at in the prior years. And which is where the re-rating that you can look at the sector will still be limited from here. And that's where we believe that the sector return can be lower than the ROE now.
Okay, fair enough. Let's also get in a take then as to what exactly you're anticipating going down the line. After the kind of quarterly numbers that have been delivered this time around, what's the expectation going into the next quarter? Do you believe that we will continue to see healthy loan growth across the board? Can you break it up in terms of which banks could positively surprise on the upside?
I think growth is still going well for the sector. If you look at Q1, itself has been stronger than how the trends typically are in the first quarter of the year. And we have seen a good pickup in deposit growth also at the sector level in Q1. And which is where we think that the growth numbers per se for the sector will still be broadly as per the expectations, and they should track well. We are not comparing loan growth to FY23 because FY23 was a very strong year in terms of loan growth. But for the year, probably 13.5% sort of credit growth for the system looks likely, and wherein private banks will be doing better than that. So they could probably be in the 17 to 18 range in the sector level. And but it's mainly to do with the earnings and the margins, wherein we are expecting moderation to continue. Probably the 2Q margin compression at the sector level will be higher than what we are looking at in Q1. Now, some banks who have already taken a big hit in Q1, of course, they will do a more calibrated fall. I'm mainly like, there have been only few results that have come till now. And if you look at AU Bank has reported a 38 basis point compression in margins in Q1. So the bank has been guiding for a more calibrated fall in margins from here. But for the sector, I think the Q2, the decline will be more than Q1.
And, you know, let's get in a sense when it comes to growth as well, because there's different commentary coming in from the likes of an HDFC Bank. They're saying they're letting the business go on the corporate front, due to some mispricing. ICICI Bank is talking about a 20% growth for corporate. What's your outlook on the kind of commentary?
Yes, I think every bank looks at their growth opportunities given how the market pricing and the opportunities that are coming their way, and that's how they evaluate the growth. So we have seen some differences in terms of growth rate across banks in different quarters. But by and large, we think the growth rates will stay healthy for the year. HDFC Bank this quarter was, yes, cautious in the corporate loan growth when we have seen a sequential decline, in fact, in the corporate loan book. But over the year, particularly for the second half, we are expecting the overall loan growth to recover. And which is where, if you look at the loan growth that we are penciling in, is close to 17% CAGR up till FY26.
I mean, I look at the economy. The economy is doing okay. Rural income is under pressure. The agrarian economy is under pressure. There are job losses which are happening in the IT world. New job creation is a problem. But if I look at the numbers from banks, they're going gangbusters, 15-20% credit growth. So I'm just trying to connect here. Whom are these banks lending to? Because I don't see too many options available at least.
Yeah, actually, there has been a disconnect, and we have also tried to find that answer with different banks. But if you look at HDFC Bank, which has been having the largest portfolio on the CRB within private banks, it has been growing at almost around 29% in the CRB portfolio. And the bank continues to guide very steady growth for the next 3 years. So I think a combination of low penetration, geographical expansion, and even the new branches that these private banks are opening at a very high rate. And a lot of this credit generally gets originated from the branches. It's not driven from the, say, head offices or the main centers. It's mainly the branch driven. And that is enabling these banks to report healthy numbers when it comes to the retail and the rural credit that they are delivering. And going forward, I think that as that continues to gain traction, we are looking at continued branch expansion at a much higher rate than what we have seen in the prior years by almost all the top private banks. I think that will be one of the key driver of credit on that piece. On the corporate, I think growth overall may still remain controlled. We are still looking at moderate pickup in capex, and probably as you go forward in FY25, post the general elections, you can see some more activity there. And which is why we are still looking at a credit growth lower than what it was in FY23.
Sure. Great to have you, Nitin, with those thoughts on the show. Thank you so much for taking the time out.
Thank you so much. Thank you.
Let's move on. Let's discuss some more earnings. We have with us the CEO at Sign DLM joining in on the show right now, Anthony Montalbano, joining in on the show to talk about how their quarterly performance was and what the visibility going forward is. Anthony, great to have you on the show. Thank you so much for taking the time out. You know, while your year-on-year numbers have improved, I can see sequentially, quarter on quarter, there is a slip. Is there any other factor other than seasonality that led to the sequential softness?
You know, overall, the business growth has been quite robust, and there usually is some lumpiness in the business that comes often in Q1. But overall, the outlook that we have is very much on track overall. And I think you'll see that as we continue to operate to our plan.
Okay. When you say lumpiness, is this seasonality, and will the seasonality play itself this year as well, which is like you said that Q1 is slow and then it will pick up in the second half, or do you see this year being different?
No, I think it's pretty much as you described. You know, this is a pretty normal part of the business. There will be certain orders that come in at certain volumes, and as things shift around, you might find some of that. But again, our outlook remains very much at the growth levels that we're seeing, and this is our view on H1 should definitely make up for what we've seen so far.
All right. Just to also give us an outlook as well in terms of aerospace and defense, because that has seen a fairly decent growth. MedTech, though, on the other hand, is a bit lower this time around. Do you think that this is going to be a trend down the line, or do you think we can see the overall, what do you think is going to be the key driver of growth segmentally, basically?
Yeah, there's no question aero and defense is a core competency for us. This is an area of expertise and where we are an industry leader. We really only focus on 3 core areas, and the medical and industrial sectors are going to have significant growth for us. So we do see actually over time, aero and defense will probably start to become a relatively smaller part of our business over time, and medical and industrial should grow as a percentage of our portfolio. So as you start to look out of a couple of years, based on what we see in the pipeline and the type of opportunities in our focus areas, we see a kind of a balancing across those sectors. But there is no question that some of the big programs that we're delivering in today and this fiscal year are more aero and defense, and we do expect, and we do have some significant opportunities in that sector as well.
So suffice to say that both aerospace as well as defense and medtech will see a jump up in terms of growth. I know you categorically clarify that medtech as well is going to grow as part of the percentage sales in the revenue pie, but does that also translate into better growth?
So it does. As we look across these 3 sectors, we find that the overall value and profitability across the sectors where we engage actually provides very similar returns. And so it's really the nature of the type of work we do. We are focused in low volume, high mix, mission critical and safety critical, right? So these 3 sectors cover that. And in this type of manufacturing solutions, you'll find that the margins and profitability in those sectors are actually relatively similar. So even though there'll be a rebalancing, there's actually, from a profitability perspective, these sectors do generate similar margins for us. And and even defense, that can be broken out a bit differently, right? There's different types of defense. There might be India defense, which has a different margin profile than what you might find in U.S. defense type business. But overall, we do see similar returns across these 3 sectors, and this is our main area of focus.
Sure. I wanted to get a picture on your order book as well, because we understand that currently stands at about 2,500 crore rupees. Talk to me a little bit about the nature of the deal wins. Is it from new customers? Which verticals? What's the timeline of execution?
Yeah. Yeah, so this is a substantial order book, and this will, as far as the makeup of that, it will continue to be in the sectors that we have discussed, and we do plan to execute. It'll take us probably a couple of years plus to go through that full order book. And we do plan to cover a good portion of this in the next 12 months as well. So overall, this does continue to fuel the growth for the business, and this also continues to give us momentum to build on this with existing and new clients. So we do anticipate to have some announcements in the coming quarters, which should continue to complement the type of profile we have, right? For the size of business we have, we really work with industry leaders, very large multinationals, our client base. And so for us, it's really more about the type of client, the type of engagement, and really working with industry leaders as opposed to the volume of clients, right? So when you look at maybe more consumer type business or higher volume business, or more regional business, you might find a client count to be a very important barometer of the health of the business, where for us, it's more about the types of programs that we're able to engage in with our current and new clients.
So Anthony, what role do you think AI will play in your business? Everything is now getting so much dependent on AI that every sector is getting disrupted. Do you see that fear happening in your business?
There definitely is a role for AI in our business. And, when you look at the engineering design side of it, it might be even more amplified. This can impact how our design aspects, right? So when we see Scient DLM, that is design-led manufacturing. We are unique where we are probably one of the only global electronics manufacturers that has the ability to leverage the 7,000 design engineers within Scient. And so AI can definitely play a portion of that side of what we deliver for our clients. Even on the manufacturing piece specifically, supply chain is a huge area of focus for our business, for our clients, and a lot of initiatives on how that supply chain is managed on all aspects. There's definitely a role to be playing there. And then we also see it even in how you run a business, from overheads, administrative. There's certain aspects where some of the tools available to us now allow us to operate more leaner and more efficiently. And this will continue to be an opportunity for us to explore.
Okay, thank you for joining in and sharing with us that outlook on the business and how things are shaping up. That's the management of Scient DLM talking about how the second half is going to be better than the first half. Aero and defense is going to continue to see a bit of a dip over the medium term, but they've got strong deal wins from their existing clients with an order book that will be executed in 2 years. The stock, in fact, seems to be reacting to that commentary, and as we speak, has just about ticked into the green, nudging that level of 500. That's Scient DLM in trade for you. AU Small Finance, that continues to remain under pressure. Then in today's trading session, remember you had their overall NIMs that did come under pressure. You've got Vedanta as well. Numbers have come in below street estimates. So that stock as well is under pressure, and it was a net loss that expanded for a Tejas Networks. So that stock as well continues to remain in the spotlight. But with markets near life highs, a lot of ace investors are rejigging their portfolios. So what exactly is it that they are buying and selling? We've got Sharad here who's walking us through their smart portfolios. Sharad?
Well, today we are having Ashish Kacholia's portfolio as well as Mukul Agarwal's. First, we'll point out Ashish Kacholia's portfolio, and of course, most of the action coming in the small cap space. Over here, we see Yasho Industries. There has been almost a 18 basis points hike, but he has actually reduced his stake when it comes to Chalet Engineering. Two new names coming up, new entries, Venus Pipes and SG Finserv. Earlier it was called Mungiba Securities. So that is where we are getting a new entry. Apart from this, also we are having stocks such as Knowledge Marine and D-Link, which are actually in focus. It was kind of a buying happening, but do remember that the two exit is happening, and these are the two names coming from the United Drill as well as D-Link. So this is coming in, the first one is coming in for Ashish Kacholia. Apart from this, next move would be investor Mukul Agarwal and what smart bets are happening. And yesterday itself, an interesting development happened. Suzlon Energy reported its shareholding pattern and stock has been buzzing, and we see a new entry coming in. Earlier, his name was not there in the shareholding pattern, but there has been a significant kind of a reduction coming in for Ethos, almost a 0.55 basis point. Apart from this, Raymond Iron Exchange also we saw cuts coming between 15 basis points. Lastly, I'd like to point out new entry coming in for Zentech. The stock is basically a kind of a view coming in for the semiconductor, and also Surya Roshni, Newgen Software. That's where he has paired his stake.
Okay, very interesting portfolio rejigs coming in, and Sharad tracking all of those. Sharad, thanks very much for highlighting Ashish Kacholia's portfolio. Let me on that note also welcome on board the MD and CEO at RBL Bank. We have with us Mr. R. Subramaniam Kumar joining in on the show right now. So thanks so much for joining in today on 18 Hour. Firstly, tell us about the cost of funds because they've moved up sharply. How much of the repricing is done for you and where do you think it'll peak?
See, as for the existing deposit, most majorly it has been done in the Q1, and there will be a minor corrections which may add up to my cost by 10 to 15 bips in Q2. So thereafter, it is a question of only business as usual. The repricing, once it is done with, but we are not much disturbed with this repricing, which is going to happen now and then. But my NIM and the margin is protected for the simple reason. You would have seen the business mix has changed thoroughly from what it was in the year before and what it is today. So if you look at it, my retail yield is somewhere around 14-15% average. And if you are able to shift some of the wholesale and low yielding to that of the high yielding, we will be able to protect this 10-15 bips, which is just getting added to the cost. So we will not be less than the whatever the current NIM is, and rather we will move up by 10 bips by next quarter, and we'll hold it. Thereafter, it will keep inching much progressively thereafter.
Now, your Q1 loan growth has been very strong. How should one look at the full year loan growth?
Yeah, normally the people say that the Q1 is a little typically a laggard as far as the loan growth is concerned. And despite that, the conventional thought, we were able to beat the conventional thought with the 21% of the overall growth and 34% of retail. Going forward, we will continue to maintain that trend of around 20 to 22% overall advanced growth, with clear focus on retail growth of 30 to 35%. This comes from the very big conviction and the models which we have created in the last 6 to 9 months. One, repositioning the products again back on the shelf, which is the mortgage loan, which is doing around 600 to 700 per quarter course. And our microfinance, which was rather timid or rather stopped growing from March 21, it has bounced back again. We do around 2,100 crores per quarter, which will continue to be done. And additionally, we are getting into a few other products which will start scaling. You would have seen the scaling of RVF, that is our tractor finance, which is doing around 300 crores per quarter. And Q2 and Q3 will continue to perform the same way. So we are confident of achieving the same level of 20% overall credit growth and 30 to 33% of retail credit growth.
All right, and wanted to also understand, because the last time you spoke, you suggested that the large cross-sell opportunities are available. How is that playing out for you?
I'll tell you, we are really, really excited about this particular journey which we have started. our analytics team, which has been working deeply into it, was able to generate. First thing I'll just start with, liability customers, we have launched gold loan recently. We just scrubbed the data to find it out that how many of them will be able to hook on. We identify the customers who can avail up to 2,000 crores of gold loan alone from the 2 million customers whom we have. We have already started gold loan in 300 plus branches already. And with this is going to be extended by end of this month or mid of next month. By end of August, all the branches of the bank will offer the gold loan. So we have started tapping the customers' liabilities who have availed gold loan elsewhere, and on its maturity, they are going to come to us. To that extent, it has been done. The second, the 5 million customers of a credit card, we are now harping on harnessing that data for opening the liability, which has already started in the month of July. So these are the customers who have been using our card consistently and who have a spend as high as 16,000 rupees. Right, and spend, which is fairly high when compared to the credit card. Those people, we are bringing them on the liability. That setup has already been created. The third point, which is a very important one, is that we have identified the customers who are working within an MFI space. There are a large number of them who have availed a two-wheeler, are interested to take a two-wheeler. And that is one referral program has already been started between our RFL services to the my two-wheeler business, which has been just commenced in this quarter, and it will start scaling next quarter. Then very interesting one, what we have seen is that the people who have doing our LAP loan, that is our mortgage loan who have taken, we scratched the surface of it and we found that large number of them are interested to take the business loan, which is hitherto we were not having it on our shelf. Now we have that on the shelf.
Right. So adding how many customers currently you think, and how many for the full year?
Today we are adding 1.24 lakh of customer per month onto our fold. This customer fold is in respect of our MFI and liability part. Now we are adding on average, if you look at it last year, every month we add around 1.75 lakh of customers under credit card. Right? On the liability side, pure liability of opening our segment loan, liability, what we call an affluent section, we add somewhere around 30,000 accounts. That is a straight pure account which is being added to my branches. And in addition to all these things on an asset side, now we have started adding somewhere around 10,000, 20,000 customers in a quarter. So if I put together, addition itself comes to somewhere around 2 lakhs to 2.5 lakhs of customer who was just getting added. So going forward, this number, when I compare to the last year, it might have increased by 50%. By moving forward, it may not increase at 50%, but it will be gradually increasing at 20, 30% because the base is increasing now. So these customers whom we are adding, they belong to multiple sections of the pyramid. Everybody is not at the top of the pyramid. Some are in the middle, some are at the bottom of it. So we have started positioning our products in alignment to that segment of the pyramid which they belong to. MFI, we are providing them a gold loan, providing them a two-wheeler, providing them a business loan. It was heartening to note that quite a good number of now, with MFI getting into the family level, we are able to get into that family of the MFI borrower, and we are able to bring them on board. This is a low value. That numbers will be increasing. It's a high margin and low value. In the mid segment where the branches and liabilities are there, we have a large locker. So locker availment was somewhere around 60%, now inching up to 80%, 85% of my lockers are going to be available. So this is an affluent mid-segment, which is adding into the 3 or 4 products which we have. We were not having it earlier, now we have it. Now all these products are adding to that customer.
Now you'd guided for a 1 to 1.5% credit cost in FY24. Are you confident of achieving it?
No, there will not be any surprise. We will continue to maintain our thing. We will stick on to that commitment what we have given. The Q1 is a demonstration of our thing. If we're going by that 4 times, it's going to be on 1.6. So it will be in the range of 1.5 to 2%. We will not give you any surprise in that space.
Okay, and given that your cost to income continues to remain elevated at 66.5%, do you think it can moderate, and what's the timeline?
We have to understand one basic point. The business model of the bank is, we have around 20-25% of the business is in the credit card. The credit card per se is that the higher the business, higher the cost. So it can't something which cannot be less than 60-65%, which is by default. So around 25% of the business is going to consume the cost which is given. So keeping that in view, first task is to contain the cost, which we have demonstrated very clearly that the cost has been contained. Why the cost shot up? Because we invested in manpower, we invested in the branch, we invested in technology. Now, a lot many products have been added now. Despite adding the products and the manpower to those, we were able to demonstrate that the cost is contained at the level what it was in last 3-4 quarters. That's one. Second, going forward, there may be, the cost cannot come down, but the income will go up multifold. So thereby, we will be in a position to bring down. That's one particular point which I was telling in the last quarter also. Now we had a 15% was my NII last quarter. Now it is at 21%. So this 21 moves around 25%. Then my cost being contained in the same level of 15 to 16 or 18% of the growth year on year, we will be able to bring down at least 1 to 1.5% every quarter. Maybe if you look down, by end of this year, we may be touching somewhere around 65 to 64 from 66. Thereafter, it will start declining and we can't reach the stage of 40. Let us be honest in admitting it because of the nature of the business, what we are handling it. But we will be in mid 50s or, higher 50s. That is the point we are looking at it in a period of 2 to 3 years.
And fair to assume that this is obviously going to cause an uptick in your ROAs?
We are focusing on ROA not from the cost reduction alone. We are looking at the increase in our income. That's going to be one of the major focus area, because you would have seen that the income which was not going up. If my book is growing at 34% of the retail, which is giving me a fair margin, which is not there in my wholesale. So today the wholesale and this 56-44%. Retail is 56-44. ROA is going to be contributed majorly from the income growth, and it is going to be little accelerated with our cost.
Okay, appreciate your time. Thank you so much for taking time out and joining in and giving us a view on RBL Bank. That's the stock at about 218. Time for a very quick break right here on the show, but don't go anywhere because we will be connecting with the management of Glenmark Life Sciences. We've got Chartbusters and lots more corporate voices lined up.